We've seen a pretty impressive rally in crude oil prices this year. Of course, in recent sessions, a lot of assets have come under pressure. And West Texas Intermediate, particularly yesterday, was not an exception to that rule. We're finding a bit of firming in activity today at 67.42, but there's a lot of things at play. The pandemic, OPEC, and the allies. What can we expect from the energy market going forward? Let's bring in Josh Young, he's Chief Investment Officer of Houston-based hedge fund Bison Interests. Josh, always great to have you with us. Yesterday was a bit of a strange day, and I thought, could OPEC's timing have been any worse, as people were worried about the Delta variant to come out with a rise in production? But of course, all these decisions are longer term. So longer term, how do you see this market?
Yeah, that's a great question. I think it's interesting to see OPEC coming out with their decision and the market's reaction to it versus the market's reaction a little over a year ago when OPEC couldn't come to an agreement and ended up in a price war, also as kind of the first wave of COVID was hitting the market and hitting demand. So the Delta variant seems to be really different and doesn't seem to be hitting world demand materially. I think Goldman came out with an estimate that they think it'll maximum affect world demand by about 1 million barrels a day, which would be relatively small compared to, I think COVID might have hit at a peak 30 million barrels a day of demand last year. So relatively small. And then the OPEC Plus agreement actually seems pretty good and pretty supportive and seems to be resetting the production ceiling, but not necessarily guaranteeing that OPEC members and Russia will actually produce the amount that they're now allowed to produce.
Yeah, when I think about the asset classes that sort of can best represent the reopening trade, I can't think of one that fits the bill better than energy. So really, this would be predicated on the fact that, as you said, the Delta variant doesn't hit demand like the initial pandemic onset did, and we don't have this kind of dramatic pullback, and the world still wants to consume crude.
Yeah, that's right. And we're seeing more demand than consensus had expected, and we think that that'll continue. So it's actually, if you just look, excluding the Delta variant and the potential demand hit from that, if you look at the amount of production that OPEC Plus is bringing back onto the market, and then you look at the amount of production growth in North America and outside of OPEC, which is almost no growth at all, we're actually seeing an undersupplied market, and we've been seeing inventories fall in the U.S., which is kind of an easy market to track because the government reports it on a weekly basis. We've been seeing inventories fall for a number of weeks now, and we expect that to continue. And so, I think these OPEC barrels are needed, and I think there's actually going to be a bit of a problem as some of the OPEC members either aren't able to deliver on their additional capacity or choose not to. We may continue to be in an undersupplied market.
What about the Western oil producers? I'm thinking about the United States. I'm thinking about Canada as well. Have we invested enough in our infrastructure in recent years to, say, ramp up to a certain degree? I just feel like when I talk to people, particularly in the Canadian industry, there seems to be this hesitancy to sort of go all in when oil prices are on the rise, that they just don't have their sort of head in that space.
Yeah. I mean, I think that part of my bullish view on oil is that producers are being very disciplined in terms of incremental capital spend. And so you're seeing a lot of producers that historically had outspent their cash flow now actually spending less than their cash flow and taking their excess free cash flow and using it to pay down debt, buy back stock, acquire additional assets, do other things other than increasing supply into the market. So we're actually, I think, seeing a shift maybe from producers drilling too much to maybe producers not drilling enough. And so I guess the question specifically about infrastructure, there might actually be too much infrastructure that's either built or that's going to be coming online over the next 18 months. And so we've seen and we've had a lot of success in finding companies that had suffered from there being insufficient capacity and where they had bad local realized pricing. And some of those companies are the biggest beneficiaries of this kind of post-COVID world. Even with oil prices down like they've been over the last couple of weeks, they're still big winners as their local realized prices are way higher than they were 6 months ago or a year ago.
Josh, I understand that your fund is up 240% year to date through June. Our audience hears that. They probably want to pick your brain then about where do you invest in this climate in terms of names. And you have a few names for us. I'll run them down.
Sure. Yeah. So one name that I've gotten asked a lot about, and I've seen getting touted recently, that we're actually not invested in, and don't see as like the best way to play this continuing oil recovery. Again, there's been a step back for us and for oil and gas stocks since the end of June. Is Suncor. And it's really interesting. Part of what Bison has done to kind of outperform post-COVID is going back and looking at research and looking at kind of consensus views pre-COVID and looking at where good wells have been drilled, looking at where there was infrastructure that was built, and then trying to see kind of what's happened now and what's changed. And one thing that seems to have been lost were the issues that Suncor was having pre-COVID, where you saw like Canadian Natural Resources and some other competitors kind of catching up and exceeding both from a share price perspective and from a valuation perspective, where Suncor has a limited mine life without big mine extensions and a need to spend extra maintenance capex. So I've been trying to avoid companies like that have these sort of structural problems. And I think it's really helpful to look back at some of those older views, because there was a lot of work that was done to build those views, and it's really easy to kind of forget kind of what was happening, what companies' struggles were, as well as what their great successes were. So that's one example of something that we're actually avoiding, and understand that it's kind of a widely held name and something that's very well touted, but and is on the larger side. But we don't necessarily have a problem with larger companies. It's more of a question of how much maintenance capex do they actually need to spend, and how does whatever company it is stand up relative to other oil producers, as well as to kind of the overall market, and is it worth kind of risking our clients' capital for that?